This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, value investors. Welcome to episode 34 of Value Investing. Over the last 4 episodes, we talked about Peter Lynch in terms of his golden investing rules. And also we talked about how he invests his money in bank stocks and also cyclical stocks. On today's show, what I'm going to do is I'm going to talk about MLP, Master Limited Partnership. And it's going to be quite interesting. And the content of today's episode is also from the same book that Peter Lynch wrote, Beating the Street. I'm going to include the link in case you want to buy from Amazon. And as I mentioned, Peter Lynch is a mutual fund manager who was able to average 29.2% annual return, consistently more than doubling the S&P 500 while he was managing his Fidelity Fund between 1977 and 1990. So I wanted to know everything about Peter Lynch, and that's why I read the book and I'm covering a lot of contents on this podcast. Today's topic is going to be also quite fascinating, so I'm so excited to get into that. But before we get started, let me just give you a quick disclaimer that this podcast is for entertainment purposes only. It is your responsibility to consult with your investment professional for any investment decision. So without further ado, why don't we get started? MLPs are traded in the stock market just as other stocks. What I'm going to do is I'm going to include a link to which you can go and check a list of MLPs in the stock market. The main difference between an MLP and a regular stock is that MLP distributes all its earnings to its shareholders either as dividends or as a return of capital. So when you look at a lot of MLPs in the stock market, you will see very, very high dividend yield as a result. And they are mostly in the area of natural resources such as oil and gas, but you can find some MLPs doing other businesses such as finance, real estate, etc., etc. While some of the MLPs such as real estate, natural resource partnerships can continue to exist indefinitely, all the others must be closed out with limited time period. So these are the key differences between an MLP and a regular stock. Also, one thing that I want to point out is the tax advantage that MLP has. So MLP is treated as a limited partnership for tax purposes, as you can see from the name, Master Limited Partnerships. A limited partnership has a pass-through tax structure, meaning that all profits and losses are passed through to limited partners. In other words, the MLP itself is not liable for corporate taxes on its revenues, as most incorporated businesses are. Instead, its owners, investors, are only personally liable for income taxes on their portions of MLP's earnings. This offers significant tax advantage. Profits are not subject to the double taxation scenario in which corporations pay corporate income taxes and then shareholders must also pay personal taxes on the income from their stocks. So this is a huge tax advantage that you can get if you form MLP instead of corporation in the stock market. Some of the downsides, let's just talk about some of the downsides. Perhaps the biggest disadvantage to being a limited partner in an MLP is that you'll have to file the notorious Schedule K1 form. This is much more complicated than the regular 1099 dividend form that you have to fill out as an investor. You have to pay your accountant more on an annual basis if you buy MLP from the stock market. I previously had some experience buying MLP. I didn't really know the existence of MLP. I just purchased it because the business was good, dividend yield was good. But later I realized that it was MLP, and when I had to file taxes, it was just a huge headache for me to do this tax filing. Another tax-related negative is that you can't use a net loss to offset other income. Any net losses must be carried forward to the following year. When you eventually sell all your units, a net loss can then be used as a deduction against other income. So those are the key differences between a MLP and a regular stock, and some advantages and disadvantages. At this point, you want to ask to yourself, why should we care? Why should we be interested in this sector as value investors? As you probably have realized, MLPs are not popular among professional investors because of the additional tax filing requirements. It's just extra paperwork that a lot of investors, professional investors, would rather avoid. When professional investors, institutional investors avoid certain sector or certain stocks, not because of investment merit, but because of something else, it creates opportunity for value investors. That's why you should be interested in this sector. And MLPs are mostly doing one simple activity for its shareholders. For example, it can do some real estate management, or it can extract natural gas and oil. It can manage some shopping centers. So it's a very simple business for you to understand. So that's something that I also like, because I don't like businesses or companies that are doing multiple things, because it's going to require a lot more analysis for me to do assessment. But MLPs are relatively easy to analyze because of simple activity that it does for its shareholders. So those are the two reasons why, as value investors, we should be interested in an MLP. But as I mentioned, there are not many MLPs in the stock market. And Peter Lynch mentioned in his book that he can maybe find one or two undervalued opportunities in a given year. So there are not many MLPs that can provide you with great investment return. But still, this is the area that was abandoned by a lot of institutional investors. So it makes sense for us to pay attention to this area to a certain extent. So those are the things that I wanted to mention about MLPs, and Peter Lynch wrote multiple investment examples that he made in this area. So why don't we just go through them and see how Peter Lynch made his money in the space of MLPs. The first company that Peter Lynch mentioned in his book is called Eqk Green Acres. So this company came public at $10 and once had hit a high of $13.75. But in the summer of 1990, when investors were fretting about the demise of shopping centers along with the rest of retailing, the price dropped to $9.75. This is when Peter Lynch got interested in this MLP. At that point in time, this company had a 13.5% yield, which was as good as the yield on some junk bonds. Peter Lynch thought that this MLP is a lot safer than those junk bonds producing the same yield, because the company has principal assets related to huge enclosed mall on Long Island. So let's just go over a couple of things with respect to this company. The first point that Peter Lynch mentioned in his book is that the management owned a bundle of shares. So there is some inside ownership related to this company. Whenever you see inside ownership, that's a really good cue for you to dig a little bit deeper, because usually huge inside ownership is a plus. The second point Peter Lynch mentioned is that the dividend had been raised every quarter since the company went public 4 years earlier. So that's a really strong sign that this company might be cash cow. This company may have a really good business model. The last thing that I want to mention here is that the stock has a good chance of capital appreciation because of high yield 13.5% relative to its risk. That was the assessment that Peter Lynch derived when he was doing his analysis. And this is the type of stock that Peter Lynch likes because he can go to mall in person and check it out with his own eyes about the business. He likes to go and talk to management team. He likes to go to the mall and retail stores. If he wants to buy certain company, that's the type of things that he does all the time. And he much prefers that way. Whereas if you look at Warren Buffett, he doesn't even look at the business when he invests a significant portion of his money in stocks or when he buys private companies. So there's a dramatic difference between what Peter Lynch does and Warren Buffett does. But I think it makes sense for you as a vol investors to go check out with your own eyes. If you buy some retail stocks, then you can easily go to one of their stores and check out how businesses are with your own eyes. I think that's a really good check. Why don't we talk about mall businesses because this company owns enclosed mall on Long Island. When Peter Lynch looked at this company, there were some potential catalysts for stock price appreciation in the future. The first thing that he mentioned is that there were two big companies planning to move into the mall, and both of these together were certain to increase the revenues from rent. So that was a big catalyst that's going to bring their earnings up in the near future. The second one is 1/3 of the stores in the mall were subject to large rent increases in the near future. So this is similar to the first point, but the bottom line is that the Peter Lynch knew that the rent from these different companies will likely increase in the near future, and that's going to boost up the earning. He also checked some risks involved in this transaction. The first one he mentioned is that vacancy rate. So when Peter Lynch looked at this company, the vacancy rate for this mall was less than 4%, so it was not an issue. And it had highly leveraged balance sheet, but Peter Lynch thought that it has a great asset and this is not a big issue for his investment decision. Third thing that he mentioned is it had high P/E ratio, but this was the common characteristics of MLPs at that time. The last risk that Peter Lynch mentioned is vulnerability of any mall to recession. And Peter Lynch thought that this is also the common thing across any other stocks, so it's not a big concern for him. In 1991, Peter Lynch recommended the stock, and the total return of that year was 20%. And he also mentioned rechecking the story at the end of 1992 because he said that even though this was a good investment in 1991, it's probably worth to recheck the story and see if it's still a good investment. And he thought that this is not good investment anymore, so he didn't recommend this stock in 1992. Because he found more cause for concern. The first thing that he mentioned is that a lousy holiday season for retailers had depressed the rents. And second, Green Acres decided to forego a penny a year increase in its dividend. If a company has raised its dividend 13 quarters in a row, it has powerful built-in incentive to continue that practice. To break it for the sake of a penny, it may indicate deeper troubles for the company. That's why Peter Lynch was not happy about this suspension of penny increase in dividend. And there was some good news with respect to this company. The company had announced that it was negotiating with two large potential tenants, Sears and JCPenney, to lease the space. But it was not set in stone. It wasn't the same as a signature on a contract. It was just negotiating. So Peter Lynch thought that he would rather wait instead of just buying into this idea. Peter Lynch gave out a small tip here. Peter Lynch said that he prefers to buy stocks on good news rather than bad news. He asked questions about how many people lost substantial amounts of their investment capital when they bought on the bad news coming out of the Bank of New England after the stock had already dropped from $40 to $20 to $20 to $10 to $1 to zero. So if the stock goes to zero, it doesn't matter the timing of your investment. You could have invested at $1, you could have invested at $10. If it goes to zero, then you lose 100% of your money. So Peter Lynch thinks that you shouldn't just look at the past stock price just to make your investment decision. That's a really bad investment choice. So it doesn't matter how much percent drop happened in the past. If the stock goes to zero, then you lose 100% money. So that's kind of the bottom line. Okay, so let me just briefly touch upon another company, MLP, Cedar Fair. So this second MLP was recommended by Peter Lynch back in 1991. So let me just give you a brief background about this company. The company owns and operates 2 amusement parks, one Cedar Point on the Ohio shore of Lake Erie, and the other Valley Fair in Minnesota. The parks are open from May to Labor Day and on weekends in the fall. This company has 10 different roller coasters and has 120 years of history. Peter Lynch also mentioned some competitive advantages related to this MLP. Somebody might come up with a new ACE drug, and the companies that make the ACE drugs will lose half of their value overnight. So this is the risk related to pharmaceutical companies. However, nobody's going to sneak up and install $500 million worth of rides on the shores of Lake Erie overnight. So there's a big barrier to entry, and it's going to take a lot of time even if the competitors want to come here and take away the market share of this amusement park MLP. The second competitive advantage that Peter Lynch mentioned is that during economic downturn, 6 million or so people who live within a 3-hour drive of Cedar Point might decide to forego the summer trip to Europe in favor of staying at the amusement park. So he thinks that this is really good play against potential recession or economic downturn in the future. And there's going to be some diversification benefit because of that. And there's some side benefit for money manager like Peter Lynch because he has an excuse to go to the amusement park and test ride on various roller coasters in the name of investment research. So he really loves that idea. He just goes there for fun, and that's a really good excuse for him because he has to test ride all these things to see if this is a good investment opportunity. After Peter Lynch recommended the stock on Barron's in 1991, the stock rose from $11.50 to $18, which together with the dividend gave shareholders annual return of more than 60%. And at the beginning of 1992, he asked himself, is this still a good buy? So he's rechecking the story every year and see if it's a still good buy. In 1992, when he was rechecking his story, the yield was 8.5%. It's still nice return, but no matter how good the dividend, the company will not prosper in the long term unless its earnings continue to improve. Okay, so here's another tip from Peter Lynch. At year-end review, you can check the stocks in your portfolio and try to find the reason that the next year will be better than the last year. And if you can't find that reason for a specific stock, then the next question that you have to ask to yourself is, why do I have to own this stock in my portfolio? There might be other better alternatives that can be included in your portfolio. So going back to the story, what did Peter Lynch do? He basically called the company directly and spoke to the president. An average investor can't always speak to the president, but what Peter Lynch is saying is that you can still get the information from the investor relationships department. Contrary to the popular belief, speaking to the president doesn't always give you an edge. As an investor, that's what Peter Lynch said, because owners can always give you a reason that their companies will outperform. And 90% of them usually say that, and they are usually wrong. And you have to know how to screen out false claims against some insightful ideas from management team. Because of this reason, a lot of institutional investors don't even bother to contact management team because they will always say good things about the company. But Peter Lynch has some differing views, and he thinks that as an average investor, we should reach out to investor relations department and get all the answers related to our questions. And I did the same thing when I was investing my money in some companies in the US, and they were quick to reply, and I just found it useful to get some facts with respect to certain companies that I'm interested in. So I recommend you do this exercise and see if they respond to your request, and I think that's better than doing nothing. Anyway, going back to the story, Peter Lynch couldn't find any exciting developments at the amusement park for this MLP in 1992, and he decided not to recommend this stock back then. So we just talked about two different MLP examples. The first one was Eqk Green Acres, and this is the company that manages shopping centers. And the other company was Cedar Fair, which manages amusement parks. So as you can see, there are different MLPs doing different businesses, and if you look at the list of MLPs, you might find some interesting companies that can fit into your portfolio. Okay, so that's it for today's show. I hope you enjoyed today's show, and I just want to remind you before I end that 5-star review always goes a long way on whichever platform you listen to this podcast. You can leave your comments on your podcast platform. That's going to allow other people to find this podcast easily, and I highly appreciate your support. Thank you very much, and see you next time.